Hello, welcome to this webinar. My name is Kevin Johns. I'm a CPA at Clayton and McCurvey. We're a CPA firm in Southfield, Michigan. We work exclusively with entrepreneurial companies, middle market, growth-driven businesses. And my area of focus is in architectural engineers. And so working with outstanding professionals as yourself, helping them through the full suite of traditional tax and accounting services. And then we've also have a lot of consulting services that go along with it. And it's that piece that leads us really here today. I'm excited to introduce to you one of my partners, Ben Smith, who heads our digital advisory services. And Ben is going to be talking with us on this data side. And so couple housekeeping things before I turn it over to Ben. We certainly encourage any questions. And so if you have questions, please use the chat feature and we'll make sure that we get those answered. If they're easy to answer during it, I might send you a response. We may save some and we'll do them at the end. If for some reason we don't get through all of your questions and we don't get you answers, we will follow up with you and get you those, but we should be able to get those all in this time. And so with that, let me go ahead and turn over to Ben so he can introduce himself, and then we'll get into the presentation.
All right. Well, thanks, Kevin. Good afternoon or good morning to everyone on the line here today, depending on where you are. I'll say here in Michigan, it's balmy 70 degrees outside, which is great for it being November 10th, and allowed me to wear my favorite polo, which you probably can't quite make out, but it's got a bunch of charts and graphs all over it. And it's the shirt that I try to wear anytime I'm talking data analytics, which is probably one of my favorite topics. So as Kevin mentioned, I sit in our consulting practice. I focus on two areas. Really, I focus my career on two areas. One being transaction advisory services, which is a lot of what's called quality of earnings studies, financial due diligence. And the other piece is helping people getting a little bit better at getting value out of the data that their organizations possess. And today we're going to talk about how data analytics can drive business valuation. To do so, we're going to start out by setting the table and just discussing what those real drivers of business valuation are, so we can level set the table there. And then we'll start talking about how you can apply data analytics to measure and grow your business value, right? So we here at Clayton McCurvey see a total of maybe 8 or so drivers of business value, 4 of which we're going to talk about in depth today because they're really kind of ripe for the data analytics space. The first driver of business value that you see on the screen here is financial performance, which probably doesn't come as a big surprise to folks on the line, but the exact definition of what we mean by financial performance can be a little opaque or uncertain for folks. So when we talk about financial performance of an organization, of a firm, we're really talking about EBITDA, and we're talking about their growth rate, okay? So EBITDA, for folks that might be unfamiliar, is earnings before interest, taxes, depreciation, and amortization. It's really looked at as a quasi cash flow by buyers and investors of business. And typically when a buyer or an investor values a business, they're looking at it as some multiple of EBITDA. Now there's a bunch of different valuation techniques out there, but generally in practice, what we see buyers and investors concerned with is EBITDA times a multiple. So for instance, if your business is throwing off $1 million of EBITDA, a buyer might look at you and say, we'll pay you 3 times EBITDA. That might be $3 million. In other words, your business is worth $3 million. Now, if you're able to sustainably grow EBITDA over time, right? So your EBITDA grows from $1 million to $1.5 million, that buyer might be willing to pay you now $4.5 million, or 3 times 1.5 versus the $3 million that they were willing to pay you before. The other big component of financial performance that we see driving valuations is a firm's propensity to grow. Do they have a proven track record of growing at, say, 10% or more a year? Firms that grow at an inflationary rate or nominal 5-6% a year generally don't command a step up in that multiple, but firms that are out there growing at 10% or more a year on a sustainable basis, that they really have a secret sauce there. Buyers might be willing, as a hypothetical example, to give you, instead of 3 times EBITDA, they might give you 4 times EBITDA. So in our $1 million EBITDA example, you might be getting paid $4 million for your business versus 3. Okay, so when we talk about financial performance as a driver of business, those are really the things that we're talking about. It's growing EBITDA, and it's kind of concentrating on your ability to increase your growth rate. The second thing that we look at, or the second driver that kind of goes hand in hand with growth rate, is your market niches. You might be familiar with Warren Buffett saying that he always said he liked to invest in companies that had deep and wide moats around their castle, right? Companies that had strong footholds in a marketplace that were very difficult to topple. So in the AEC firm space, that's, having a firm that is very concentrated on a specific sector. So whether it's sustainability engineering, land planning, healthcare facilities, educational facilities, some market that you're very good at, that people come to you for because of your skill set, something that you have a strong foothold in. And the reason there is buyers are always looking to increase certainty of future revenue and profit. All right. While we measure very often a company's kind of value based on EBITDA, which is typically a historic measure, what investors are really doing is looking at that EBITDA as an indicator of the earnings that the company will see in the future, right? Buyers buy future cash flows, not past cash flows. And having a market niche that you're very skilled at, that people come to you for year over year, means that there's much more certainty that your revenue and your profits will continue into the future. All right. And speaking about reoccurring revenue, that's our third driver here that really can impact business value. So a lot of people out there think that recurring revenue might be a concept that's reserved for the software industry, where a software company might be able to sell a 3-year subscription that you pay for on a monthly basis, and you're guaranteed that revenue over the next 3 years. That's not necessarily the case. AEC firms can have reoccurring revenue as well, which buyers and investors value. It just comes in the form of reoccurring clients, longstanding reoccurring clients that have a great history of buying from you. So if you have 10 clients that make up 50% of your revenue, that have been clients for 10 years, that come to you for a specific niche specialty, there's a lot of certainty in that continuing revenue stream. It's much different than a business that's going out and proposing on or sending out RFPs, RFQs, or responding to them rather in 2023, for instance. In other words, they don't know where their revenue is going to come from next year, because it's all based on RFPs that they're going to submit at some point next year, right? Knowing that your revenue is coming from, or there's a great likelihood that your revenue is coming from a set client base, can greatly reduce risk and improve business value. And the last driver that we have here is your cash cycle, which, especially in the transaction world, we kind of refer to as working capital, all right? And in the AEC space, that's typically your accounts receivable, your unbilled receivables or work in process, and your accounts payable, and your ability to manage those items. So it's your ability to collect on your accounts receivable timely. It's your ability to bill timely based on contract terms, which reduces your work in process, contract asset, contract liability, and also your ability to maximize vendor terms and payments, or in other words, increase AP. Because the combination of those accounts, your accounts receivable, your unbilled or work in process, and your accounts payable, really represent an asset or an amount of cash that you have tied up in your business, right? And the lower you can make the combination of those three accounts, so the greater your AP, the lower your AR and working capital, while still maximizing your EBITDA, increases your return on investment. So if your AR, unbilled, and AP is what you have tied up in the business, the lower you can make that number and the bigger that you can make EBITDA, creates a much larger return on investment. Right? So what do these metrics have in common? They all have something in common, actually, although it might not be readily apparent, and that these measures are typically, from what we see, rarely analyzed on a regular cadence by AEC firms in the middle market space, and they're always deeply analyzed by buyers. So, as I mentioned earlier, I am responsible for two things in the firm. That's data analytics and transaction advisory services. And what we do in transaction advisory services is help both buyers and sellers validate really the financial information that's being presented in support of a transaction. So when I work with buyers, for instance, we spend a lot of time validating the results, validating the EBITDA that a seller says that their company earned over the last 12 months, right? And typically we'll go in, look at an EBITDA of, say $1 million, we'll look at their revenue practices and find that there's some uncertainties or some practices that don't conform to GAAP. And when a seller thinks that they have historically produced $1 million in EBITDA, maybe last year was really only $750,000, right? So we'll help buyers validate that number and get a ground truth there. We'll also help buyers look at a seller's revenue by market niche, right? And maybe through due diligence, they find that a seller is focusing on a particular market, or a particular market makes a big segment of their business, and that market might not have a great outlook over the next 3 to 5 years, which can cause a little bit less certainty in the reoccurring revenue that that firm might have otherwise had. Other times we'll see that, a firm might have lost a couple of reoccurring customers in the most recent 12 months that was offset by a large project or otherwise mass that we couldn't see. So that's something else that we uncover pretty regularly. And lastly, we'll spend a lot of time working with buyers and understanding what the right net working capital number is, right? And very often, like my first example about EBITDA, we'll find that if there's non-conforming revenue practices, we also have a working capital number that is difficult to rely on as well. All of these things typically detract from the value of a business, or at least what the value that the seller expected to receive is. Okay, so they all can create pretty significant retrades or pretty significant changes in deal terms. You might ask yourself, why aren't these measures as regularly monitored if they are this important?
And Ben, I'm going to interrupt you here just for a second, and before he gets into that, and I just want to make sure, because that last slide is really important, that that we make sure that we understand as we transition into this next one. In that, I mean, it's no news to you guys that you've been seeing out in the marketplace over the last several years, private equity has really come in. And the reason they're coming in, right, is they're not philanthropic. They're not looking just to help out. They're looking and saying, hey, there's a lot of potential in here. This is a great market, it's a great industry with a huge upside. And if we can come in and bring some better practices and fine tune this a little bit more, there's lots of money to be made here. So basically, some of this is getting to, this is really the how you get measured, and how, it's kind of, if you tell the doctor, you tell somebody who says, yeah, I feel pretty good, about your health. Well, you're going to go to the doctor and they're going to do a bunch of tests. They're going to draw your blood. They're going to do your blood pressure. They're going to look at all these things. And these things will really come and tell you, in addition to how you feel, but there's going to be some hard numbers that go along and support it. And it's the use of these. And so, as Ben was saying, really what's driven this, and we've had these conversations with Jamie Clare and Will and some of the great consultants that Zweig has, is, boy, as these firms reach a point of doing a transaction, if they just would have done some work a few years before, they could have not just had a better value, but they could have made more money along the way. So it really is, these are really best practices, is how you get valued. And we're just not doing those. And now Ben's going to get into, so it's like, but you hear that, you're like, well, yeah, we should do these, but there's reasons we don't. And so Ben, why don't you go ahead and talk about why this doesn't happen, even though we see it, we hear it today, like, well, yeah, we should do this.
Yeah. So I'll say that most often it's because AEC firm owners are relying on intuition and heuristics to run their business. Not necessarily because data doesn't exist, but because they don't have time to go and access the data and get it into a usable format, right? So instead, they revert back to using intuition. So for instance, when we talk to firm owners and we talk to them about their cash cycle, we'll use accounts receivable as an example. We ask, do you regularly collect all of your accounts receivable? What are your days pay or days receivables outstanding? They say, yeah, we're pretty good at it. We don't write anything off. We don't have anything really outstanding. And then very often we'll actually get in and start digging into the invoices and find out that that's not the case, that intuition might have been based on, how the business operated a couple of years or even months before, right? And then the same thing we see on the financial performance side of things, your EBITDA side of things. A lot of times AEC firm owners kind of look at their business as a funnel. And if they're, checking every couple jobs or every couple projects, quotes to make sure that they're profitable and those are running through the funnel, oftentimes they'll just kind of say, well, inherently there should be some profit left at the end of the year, which isn't always the case, right? And to be clear, I think intuition still plays a very valid role in making management decisions. It's just there's an opportunity there to use data to validate those decisions. The other reason that we see that folks don't kind of monitor these measures on a regular basis is that they're unclear about what they mean. They might not understand what EBITDA is, how to calculate it. They might not understand that it is kind of the driver of business value. They don't understand what recurring revenue is and how valuable that is. So they don't necessarily track it because it's unknown to them. And then finally, like I talked about a little bit earlier, they might know that, yes, we should be doing this. And yes, it does matter, but it's time consuming. It's difficult to track. Given the employment market the way it is, I'm having a tough time finding people. I'm just getting work out the door. I'm running my hair on fire. So I don't have time to kind of address these issues and measure these things like I really want to. Right? So those are kind of the three primary reasons that we encounter for why these measures aren't really tracked. Metrics aren't really tracked on a basis at a regular cadence. Okay, so why should you start? If one of those three scenarios is even if you've known about this and you've been putting it off, there's a couple of good reasons why you should really consider starting to track these things on a regular cadence. And the first one is, as we've said, it will create or preserve value on an exit. It will absolutely, having a good handle on these measures and metrics will absolutely give you negotiating power throughout the deal. And especially as you're stepping into the deal, if you can confidently talk about where your EBITDA is at, what your recurring revenue base is, what your growth strategy is, those things will keep the kind of negotiating power in your hands early on in the deal, pre-LOI for sure. And you might be one of those people sitting there saying, that's great, but I'm not planning on selling in the next 3, 5, 10 years. So that's not really a big reason for me. While I will say that, it's never too late to start planning if you're considering selling your business. As Kevin pointed out earlier, there is a reason why buyers have an interest in these metrics, right? It's not they don't have an interest in these metrics just at the time when they're buying your business and they put them on a shelf and file them away and never look at them again. They look at these measures because they are real drivers of business value, right? Having market niches, having that moat is something that they look to grow and build post-sale, right? Because they know that those type of activities can lead to growth, right? So even if you're operating your business and saying, I'm not planning on selling in the near future, following and starting to measure some of these metrics will improve your operations and will improve your business value. And sometimes people find that things start operating even a little bit more readily after they start monitoring their place. The second reason why I would say you should consider starting to measure these metrics is that, I do believe it's true that what gets measured gets done, right? So, and there's actually some human psychology behind that, where most humans have some degree of competitive nature, lower in some than others. But when you measure your goals and track your progress, that competitive nature is kind of elicited by just monitoring your progress, by benchmarking yourself, right? So it gives you a lot more energy to try to achieve those goals that you set out at the beginning of the year. So if you're thinking about growing a particular market niche, measuring your profitability and how it grows over time can really help give you energy to achieve that goal. And then the last reason here is that there's often a difference that we find between a firm manager or owner's intuition and the objective data that's out there. And that's typically where the opportunity lies, where their intuition differs from what the data is telling us. And there's a reason for what that difference is, which usually causes a change in how the firm manager or owner operates the business, right? Just a simple example is, very often we'll go into a business and ask, do you have any advanced billing on your projects? And the firm owner will very often say, no, we don't get an opportunity to advance bill at all. It's all progress billed after the work is performed. And then we dig into the data and we say, no, actually, you've had a couple big projects or a big project that you have been able to advance bill on, and you've got about $500,000 liability here. And that can cause a problem with business value, or at least what the seller expects to receive at closing. And that's typically due to, or I attribute that to something called availability bias. So humans in general don't have a great brain for thinking statistically. They weight their answers heavily on the most recent experience or the most readily available experience to recall. So when we ask them that question, can you progress bill or are you able to advance bill any of your clients? They typically only think back to the last 2-3 projects that they saw, and that heavily skews or weights their answer to us. So they're not trying to be deceptive. They just are recalling the most recent experiences, which aren't necessarily representative of how their business operates as a whole.
And just before he moves on, just to emphasize on that last point, with that intuition and opportunity, there's a confidence that comes from being able to make decisions based on having hard numbers, objective data, rather than just that gut feeling. Doesn't mean it nullifies your gut, and it doesn't. Sometimes your instincts do tell you what to do, but there's a confidence that comes from knowing this is what it is. And then what it also can help with, right? And you're in a people business. I'm in a people business, and so in that there's personalities, right? The politics, the personalities, the things you have to work through. Well, when you have some numbers versus intuition, it can limit some of those politics that go along with it, and you can drive decisions. And again, that's one of the things that private equity brings. All right. So with that, we do have our first polling question that's up there. There'll be 2 polling questions throughout our webinar this morning, and so we're just curious to find out from you as to how often you're using KPIs to monitor your business performance. Are you using them daily, or weekly, monthly, or hey, they haven't started yet, but maybe after today we'll put together a plan. So if you can go ahead and start to click on an answer, that just gives us a little bit of an idea as to what's going on, and we can see that. So go ahead and begin answering.
Yeah, looks like we're getting some results here.
Yeah, we go. So it's a bit mixed. So there's certainly nobody in the daily category, but we have weekly and monthly are about the same. 2 more in the monthly side than the weekly, and then some haven't begun yet. So hopefully, as we go through this, you'll see maybe things to do. You can look at what you are doing and maybe have a better plan as to how to go about doing it. Thanks for participating in that. All right, Ben, back to you.
All right. So hopefully we've convinced you that there is some value in tracking really all of these levers. But you might be asking yourself, okay, you've convinced me, yes, now's the time, I should start focusing on this, where should I start? And I'll say that a great starting place is getting to a version of real monthly revenue, all right, not invoiced revenue. A lot of times people say, I'm not really concerned about what generally accepted accounting principles call revenue, or what you bean counters call revenue, right? I look at all my job projects, I do a postmortem on my projects, I figure out what went wrong or what I can do better. Next time, and that's good enough for me. I don't need to understand my revenue or profitability. And I'll be the first person to admit that GAAP isn't always useful when it comes to management accounting and making management decisions. But in this case, real GAAP revenue actually is, because it forces you to look at the work that you're performing on a daily, weekly, monthly basis, looking at the margin that you can charge for that work, and recognize that ratably month over month, right? When a business is out there and they're using invoiced only as revenue, what happens is you might have a big milestone in November of in this month, for instance, where you can bill $500,000, but all the costs, all your people costs on that $500,000 occurred in the prior month. So in October we had a big loss, and in November we had a big net income. The average of those two is more realistic of where we're at, but what you lose when you're looking at invoiced only revenue is the ability to compare your firm's performance month over month, right? So it gets very difficult to understand trends and what's happening in your business, which is what data analytics is all about. You're never going to be at a point in time where all your projects are closed, or if you are, your doors probably are closed too. That is a great starting place, and it really is the starting point for all of the metrics that we were talking about today. You can't analyze and calculate what your true EBITDA is without good revenue as a starting point. You can't figure out what your growth and market niches are without revenue as a good starting point over time. Same thing with recurring revenue, same thing with working capital, right? Working capital isn't going to be reflective of your actual operations without real GAAP revenue.
And then just before we move on from that, just to go back to that last slide there for a second, Ben, to be clear of what we're talking about and not talking about in relation to GAAP and its financial statement performance, we're talking about on your financial statements, your internal and how you monitor. We're not talking about how you file your tax return, right? So I'm going to guess many of you are using cash basis for your tax returns. And that's probably the best answer and probably what you should be doing. And so you don't have to change how you're reporting on your tax return. You can continue to use cash basis and just do a conversion and make an adjustment at the end of the year to go from your accrual and GAAP basis to cash basis. We're just talking about as you monitor your financial statements, you need some sort of accrual basis financial statement that's looking at that's keeping score as it goes along, and not just looking at the score at the end of the game. And so, many of you have agreements as to when you can bill, and in your mind, it's like, man, I have set times or set periods. There's key marks in it. When I reach these milestones, I can bill. We're not saying that has to change. That you're going to have to continue, right? Those are the agreements you have, and that's how things get done, and that's going to stay the same. That's not changing. It's going to be just how you account for that. And so in some respects, like, man, that just seems like, accounting stuff. And it's like, yeah, it really kind of is, but it really does matter in this valuation piece. It really does matter for all those reasons Ben says. So we're not talking about changing your billing practice, and we're not talking about changing how you do your tax reporting. We're talking about changing how you account for things on a monthly basis. So hopefully that helps. Go ahead, Ben.
Absolutely. Great point, Kevin. Okay. So you might be sitting there at this point in the conversation saying, how is this all related to data analytics? You've been talking a lot about revenue. I'll say we've already started down the path to data analytics. You might not be aware of it. So in its simplest form, data analytics is a process of analyzing raw data to find trends and answer questions. All right. And that process really manifests itself in this continuum that you see on the screen here, which was originally published by Gartner Research. All right. So if you look at the continuum, we've got value on the y-axis, difficulty on the x-axis. You'll see that we've got types of data analytics, the 4 primary types that are plotted on this in this quadrant. So down here on the left, we've got descriptive analytics, which are a little bit lower in value, a little bit easier, and we gradually progress up to things like predictive analytics, where the difficulty gets a little bit harder, but the value is greater because we're taking, past data and predicting what might happen in the future, so you have a better ability to act on that, right? You'll also notice that at a point in time where we change in difficulty level, we switch from using in looking at hindsight to looking at foresight here, which is key. In the middle market, we see most folks at the descriptive and diagnostic analytics stage. Okay, we see that in your client-facing work, some of the client application and software that you purchase to deliver work might have some predictive and prescriptive type analytic capabilities built into it. But by and large, when we're talking about middle market AEC firms, their internal data, how they manage their business, they're in the descriptive and diagnostic phases, working up the continuum here. So to get a little bit more granular about what we mean by descriptive analytics, that's just talking about what happened, right? We're taking a data set, a past data set, looking at it and describing what happens. That's just simply looking at your income statement, for instance, is a very simple example, and saying, did my revenue go up? Did it go down? Or was it flat? Another example being margin. Did my margin go up? Did it go down? Or was it flat? And very often we'll see that, firms can, if they're using real revenue, can get a pretty objective answer on this front. They can't get a lot of detail beyond just top line revenue. Maybe it's segregated between what they have as pass-through costs and service revenue, but they can answer some objective, descriptive questions here. Naturally, what firm owners want to know, though, once they understand if their revenue went up or if their margins went up or went down, is why, right? And that's when we flip into the diagnostic type analytics. Why did something happen in the past? Why did my revenue decline? Why did my margin change? And this is where I find that folks start to rely on their intuition a little bit more often. For instance, we'll ask when we're doing our work with either a seller or a buyer, why did your revenue go down big picture last year? And they'll say, oh, one of my major customers, there were some project delays. We just didn't get as much done as we thought we were. And we had a dip in revenue. And we'll go in and look at that and say, well, yeah, that accounts for maybe 20% of the equation, but there's still an 80% drop here that we don't know what's going on. We see the same thing on the margin side of the equation. So why is my margin going up, going down? Oh, well, we had a job that ran over budget that really kind of dragged down the organizational performance. And when we actually analyze what happened, that job might account for 1% of the 5% decline in margin, right? So that's an example of where a firm owner's intuition doesn't necessarily match up to what actually happened in the business. And that's when we can apply data analytics. That's when we start looking, and for instance, we'll apply a feature to your customer set, your customer revenue set for a particular year, and tag, this customer is in this market, this customer is in that market, this customer is in this market, and look at the change in your mix over the year or over the years to help understand, well, maybe you're overall doing more business in this market sector, which has a higher margin to it, or maybe that customer that you said we lost some revenue on is actually in a growing, market space. So then we start to question, well, why did you lose, revenue if that market sector is growing? In other words, we start to uncover some opportunities there. But generally, we don't see middle market firms that can get to a holistic bridge of what happened with my margins or what happened with my revenue. In other words, a kind of reconciled explanation of the changes in the business from year to year. And usually when we help them build a model that kind of describes that, there is a fair amount of insight that comes out of that activity, right?
And I do want to point out in here, as you're making your way and starting and collecting this information, right? So as you start to get it and start to look at it and what's going on, this is where your partnership and relationship with Zweig and the benchmarking information that they produce becomes a great resource to you, because you can produce your numbers and you can start to compare yourself among yourself, but sometimes you don't know, is this good or is it bad? Am I ahead or am I behind? And so they have bountiful information that is only really becomes useful to you if you have your own set of information to measure against it. So, but go ahead, Ben.
Absolutely. Yeah, great point, Kevin. Okay. So at this point, you might be saying, yes, what you're saying makes sense. Yes, I'd love to see an analysis like that, but you don't understand. I've got these 7 different systems, 3 of which I need to pull information from to answer that question or to get to that analysis, right? So in trying to get to a bridge of margins, we might need to pull information from your accounting software and hours from your time tracking software, right? So you get costs from accounting, hours from time tracking, and then maybe you've got some other low code, no code solution that you custom built to help you develop budgets or quotes, right? And we got to pull all 3 of those systems together to be able to answer that question. Similarly, we find that a lot of people, even with industry specific ERPs, while they know they have the data in their system, they're entering it every day. They just can't readily access or get to that one report that answers that question or the particular question at hand in short order, right? Their CFO or controller has to run 7 different reports and aggregate some information to try to get to a general answer, right? Which is very common. That's where, if this sounds like you, that's where some data analytics technology solutions can come in handy. All right. So, and we've got a timely poll here, I think, Kevin.
Yes, we do. Thanks. And so we are just asking you to let us know if you're using any of these data analytic tools that exist. We'll talk about them in a little bit more here in a second, but you have from Power BI to Salesforce to the Google Analytics piece to the Quick Queue, Domo, Deltek, and then if you have something other, and I guess if you have a none, you can choose other. But if you can go ahead and put an answer in so we can kind of get a feel for what you are using, that would be great. Waiting to see if anything starts to populate here. There we go. All right. So I don't know if you guys get to see the answers, so I'm going to go ahead and give those to you in case you can't see them. There are 3 that don't have anything: Salesforce, Quick Queue, and Domo. But Power BI has 19%. The Google tool, I'm hoping it's the Google Analytics and not, and maybe you're just Googling, who knows? We'll keep that to yourself, but that's at 9%. And then Deltek, which doesn't surprise us, is the leader at 59%. Right. All right. And they can see those. So that's helpful to know. I didn't know. All right, Ben.
Perfect. All right. Yeah. So kind of going back to our problem here from the last slide. So, problems dealing with or getting to data that we can't readily access, and data that is wide versus long, or what we call data sprawl, where you've got a lot of data in disparate databases or applications across your organization. So that's what we refer to as wide data. Long data is you've got a whole bunch of data in your time tracking software, millions and millions of records, that there's just so much volume there, it's hard to analyze. That's long data versus wide data, which is trying to connect it. How do I connect various systems, which is where most of the opportunity lies. But tools to help you with those types of problems are things like Microsoft's Power BI, which is a great kind of low cost tool to dip your toe in and pull from multiple data sets, get information into a clean, consistent format that's able to be visualized, to help you understand and analyze trends that are going on in your business. Click is another great product out there that is great at the visualization and combining data, as well as Salesforce, which recently acquired Tableau. It was within the last year or two, so you might be more familiar with the Tableau name, which is now owned by Salesforce, but that's another competitor of Click, as well as Google's got its own analytics solution. And then Domo is another big independent player out there that has a product that's great at the ETL process, or what we refer to as the extract, transform, and load. So that's, you're pulling data out of your disparate systems, transforming it into a usable format, loading it into visualizations, right? And then we put Deltek on the list here too. Some of their more recent versions have some analytics modules that have some increased capabilities. But even with Deltek, we'll at times see a need for somebody to try to connect one of these other applications to it to get the right information. I will note that while these applications are great at connecting data, helping you go through some basic transformations of the data to get it in usable format, it doesn't change your data. They typically don't go back and insert records into your database or mess with your transactional database, right? So you're not going to see an invoice all of a sudden pop up after you've connected Power BI to your system, right? They just read only, they pull data. What gets really useful, I think, once you get your data pipeline up and running, while it kind of shortens the timeline for analyzing data and to answer questions, what these applications, or a lot of them, really do well is they create drillable scenarios where you can create a chart of what your margin is or what your sales is, which describes what happened over the TTM period. And then you can double click on that chart or drill into and immediately start to diagnose what the drivers of that change is, right? You could drill in and immediately see what the top changes in your customer base or your sales mix were that caused a decrease or increase in revenue or profitability, which is great. And then it also helps you, kind of going back to what gets measured gets done. They're great at once you've set a goal that is measurable. They're great at visualizing the progress or the progress that you make in those goals on a daily basis. If you're a controller or a CFO on the line, I'll say that one of the things these applications can also really help with is kind of that exhaustion. So a lot of times we'll talk to controllers and CFOs that I've got to create this report every month. It takes me a day to pull everything together, and by the time I get done, I'm just tired. I'm almost too tired to analyze what the report's telling me, right? These applications can help automate that report creation process. And once you've automated that process and that pipeline, then all of a sudden that's when you can move from looking at this stuff on a monthly basis to a weekly basis or a daily basis, as frequently as you want. It's typically only limited by the frequency that your data is valid. So for us as a CPA firm or professional services firm, we put our time in weekly, which means that we can only look at utilization on a weekly basis, right? Because on any given day during the week, there's no requirement for people to keep that data up to date. So it's really not very valuable. But these tools are pretty good at, and some of them are very good at helping you to unlock that disparate data sets and pricing is getting pretty competitive and is very palatable for middle market firms these days too. If you look 2-3 years back, there's some pretty big price tags on these applications. Now there's tiers that are very affordable or can be more affordable for the market.
And Ben, I'm going to just jump in just for a second. Been doing this for 25 years. And when I look over the 25 years I've been doing it, when I first started my career, I was at the beginning stages of really accounting software packages coming out where small and medium-sized businesses could start to have their own financial statement. And so but it was a process and it took a while. And if I had to have a theme of what I hear from owners over the course of these 25 years, when we sit down and to go through financial statement information, there's an eye roll. It's like, this is just old news. Like, I already know what happened. I'm more interested in what's going to be happening. And so, when to answer why are we talking about this? Why here? Why now? Well, it's really these tools that have now been out. They've been out for a while, but they're really now starting to come down into our marketplace where you can really start to utilize them. And really, once these get created and get done, you're really starting to give the operator, the owner, the real-time information, and it's not this historical drag. Yes, the history tells you something, but it's predictive, and you can start to see what's really going on. And so the why now is these tools are making to be much more they're much more impactful, and it was really hard to do before. It was it took a lot of work, and you just didn't have the time. But now with a little bit of work on the front end, you can have something. And so now Ben's getting to tell you, well, what should we be looking at? What things are out there?
Yeah. So what we find, when, at least in the engagements where we've helped people kind of segment revenue and look at some of these KPIs, what we find is that, once you get the data pipeline set up, and people are able to real time in a meeting, somebody poses a question and they're able to kind of quickly drill in and get kind of a general gut check of what's going on in the business or why something is such. We find that there's a greater demand to start pulling all this information that they have access to into dashboards, right? So they find, hey, it'd be great if we could get our overhead rate, or it's great if we could see our profit margin on an interim basis, employee utilization on a even a daily basis. And we don't want to make that sound like it's too big brotherish, so to speak. I mean, when we see dashboards and when we look at dashboards, we generally look at them as ways to find opportunity and ways to celebrate success, really not to call people out. But people really find some value when they start adding, the different types of metrics that you see on the screen here, especially in the AEC space. These are kind of a tailored list for your space from what we see, right? And then, again, as Kevin mentioned earlier, once people start setting and monitoring these benchmark or these metrics here, that's when the Zweig kind of benchmarking data can become really handy, because you can see where you stack up and how you stack up over time. We'll occasionally get some folks that say, hey, yes, my ERP can do some of these things too. So I don't understand why we would need to get a separate solution to calculate and monitor some of these metrics. And I'll say they often can cover some component of these, not all of these typically all at once. And what ERPs typically can't do is see trends over time or visualize trends over time readily, right? So you can go in and run a few reports, or you can go in and look at where your average receivables are on points in time, but it's really difficult to get to some of those usable visualizations that you can kind of drill into and move from a descriptive to diagnostic state on a very ready basis. And I'll say that I've almost never encountered an AEC firm that's been successful in creating one database, one system to run all their operations. There's almost always two different systems, which then leads to many scenarios where you've got to go to two places, run a couple reports to get the answer to a question, right? And once you have to do that, people are less likely or I'll say more likely to decide that they don't have the time to do that. And we're just going to make an intuitive call on this decision, right? So while your ERP can do some of these things, there is a significant value in at least exploring and seeing if one of these tools can be a fit for you. All right. So hopefully we have identified maybe an opportunity here to, help you start on the analytics path, a path for you to actually start on. Hopefully we've convinced you of some of the value that looking at some of these specific metrics and measures can have on your business value. If we haven't, I'll close by saying that there's a growing body of research out there that's showing that organizations that are choosing to and becoming more data driven are starting to outperform their peers that aren't, right? There's a McKinsey study that came out, I think a year or two ago, that found that digitally or data driven organizations are 23 more times likely to acquire customers, 6 times more likely to retain customers, and 19 more times likely to be profitable than their non-data driven peers. And Kevin and I can speak firsthand that folks out there that have a great handle on these types of metrics and measures are far more likely to retain and create value on a business exit. So, hopefully you found something useful here or an opportunity. Kevin, I don't know if we have any questions yet.
Yeah, thanks, Ben. Great job putting all of that out there. We're starting to have some come in. And so one was out here and now it disappeared. I don't know where it went, but it was, I'm trying to recall what it said, but it was basically on the lines of explaining the difference between a fair market value and what ultimately you might get in a deal structure when you go through an EBITDA, and how there can be a difference between those two.
Yeah, so a fair market value or valuation, there's kind of a prescribed approach where you're looking at 3 primary methodologies. You're looking at a discounted cash flow, you're kind of looking at a book value, you're looking at a precedent transaction. There's a very prescribed approach to coming to what a value of a business is between a willing buyer and a willing seller. Just kind of on the free market, so to speak, which, oftentimes can be different. So we've had or worked with clients that get a valuation and then sell, and ultimately those two numbers are different. I think more often than not, buyers and investors kind of revert back to a multiple approach, because you can kind of get to the same answer, and it's something that they do every day. So it's a little bit easier for them to kind of work through the value that they see in a business. Fair market valuations typically don't take into account any synergies at all between a buyer and a seller, right? There's just, it's just a random buyer and a random seller, which is not necessarily something a seller or buyer wants to do. They want to take into account some of those. Sellers don't necessarily get the synergies, but they want to take that into account. So, those are kind of the 2 primary differences, I guess, that we see.
Ben, here's another question. They said sounds like they're doing a pretty good job of tracking most of those KPIs that were on the list. Good. Backlog is the one that they're trying to figure out how to go ahead and solve. I don't know. I mean, it's probably a lot more in some respects, there's more information that's needed, but is there ways in which you see how that gets resolved or solved, or how you go about doing that?
Yeah, I think a lot of it's dependent on your system. So, if there is some functionality in one of your systems that we can leverage, we do that. Sometimes we see people that just kind of revert back to Excel and maintaining backlog. But typically, we'd always look at the systems that you have available in your organization right now and see if there's a fit where we can either use some type of kind of built-in quoting module or something like that in your current ERP that just has a flag on it to identify what's been worked on and what hasn't been worked on. for those jobs that haven't been started. And then we'd look to combine that with your jobs that are in progress, which typically falls into your, percentage of completion accounting. So we use, something like, in our case, a data applications software that will combine both of those data sets to come up with a true backlog. But to your point, a little bit hard to answer. I'll throw up our contact information here, and we'd be happy to talk more specifics offline with somebody if they want on that topic.
Here's another question that says, hey, do you have a range of multiples for A&E firm value using EBITDA? Maybe a range for small firms in the 10 to 50, and then firms a little greater than 50. I think this is.
I think that it can. There's a lot of factors that can affect that range, right? So I always hesitate to throw out kind of multiples like that because it's depending on your customer mix, depending on whether there's management concentrations, that range can really vary. I will say that it'd be a great question to talk to the folks at Swag about. I think they've got some great objective data on that type of stuff.
Yeah, I would agree with that. They have a ton of research that gives all that. There's so many things that could impact it that would make it sway from one to another. And there's no doubt that size matters, but it's not the only factor. It's not the only one, and not to be discounted again is your strength of your team and your next level of talent. So not only is your top talent and how much of them are sticking around, but how much of the next layer is sticking around, because in today's world we're all trying to find people, and so when firms are looking to acquire right now, they don't need more business, they need more talent. And so the strength of your bench and who you have on is going to have a factor in that piece. But all right. I don't think we have any other questions that are out there right now. So before I turn it back over to Shirley, I just want to say first, thank you, Ben. Thank you for talking us through all of that and helping us see how we can potentially go about doing it. We certainly would love to talk to you, certainly if you have any questions and anything specific, but know that we will be around, and we show up at a lot of the events that Zweig is having, and they are a tremendous resource for A&E firms. And so if you're not using them, if you're using them little, use them more. They will be helpful to you. So Shirley, go ahead and wrap it up for us.
Thank you. And right back at you. If y'all are not using Clayton McCurvey or just using a little, use more. We really appreciate partnership with you guys. You always bring something so substantial to our audience. So thank you. And I think with that said, I'm ready to wrap up for today. Look for a follow-up message in everyone's inbox this evening. We'll connect you guys directly with Kevin and Ben, and we'll go. You guys can take it from there.
All right.
All right. Thank you.
Thank you. Take care, guys.